Welcome to Cat Eye U.S. stock. We watch markets with calm focus and sharp instincts. On Friday, January 30th, 2026, the market tried to trade like the AI story was still on rails. Nothing looked broken on the surface, but under the tape, you could feel conviction shifting. Traders weren't dumping risk. They were questioning it, especially around one pillar that's carried this market for more than a year: hyperscale AI spending. Today was belief meeting discipline, and the first real cracks in the idea that AI Capex is an endless, costless flywheel. If you just glanced at the S&P 500 heatmap, the story looked almost boring. A muted, slightly green mosaic. Breath a touch positive. No index-wide washout, no sea of red. But zoom in, and the pattern sharpens. Energy, Chevron, and the big majors lit up bright green. Healthcare around Eli Lilly, Abbott, Big Pharma, and med device names was firmly bid. Staples and defensive retail, Walmart, Procter, Coke, Pepsi, lined up in steady green. On the other side, the pain clustered fast. A deep red strip through semis, AMD, Micron, Intel, Qualcomm, Analog, and another band across software and internet, CRM, ServiceNow, Oracle, Palantir, plus a weak meta tile. Even inside megacap tech, the board split. Apple, Broadcom, and a few financial and retail giants, slightly green, while Microsoft, Nvidia, Google, Amazon, and Meta sat flat to soft. On the surface, a mild day. Underneath, a decisive reshuffling of who's allowed to lead. That heat map translated into a very specific money flow, textbook de-risking out of high beta tech into cash flow certainty. Energy-led, Chevron and its peers ripped higher as investors reached for hard asset balance sheets and inflation-resilient cash flows. Healthcare, especially the mega-cap drug and device names like Lilly and Abbott, pulled in patient money. Secular growth, less rate sensitivity, real earnings power. Staples and defensive retail, Walmart, the big beverage plays, the household brands, quietly filled up with capital from traders who wanted stability more than story. Industrials, led by GE and select aerospace and machinery names, rode the resilient growth and infrastructure narrative. Meanwhile, the crowded corners paid the price. Semis away from Nvidia and Broadcom got hit hard. AMD and Micron led the downside as positioning, AI expectations, and valuation finally met skepticism. Software and key internet platforms saw profit-taking as investors reran the math on long-duration AI bets. In a world that suddenly feels more hawkish on policy and more demanding on returns. Under that rotation sat a tight coil of macro and thematic tension. President Trump's plan to nominate Kevin Warsh to run the Fed landed as a hawkish tilt on top of already sticky inflation. That alone nudged traders out of the furthest out cash flows. Then, metals cracked, gold dropped, silver plunged. A historic, disorderly move. As the dollar firmed and crowded positioning unwound, macro desks rated as a positioning shock, not a growth shock, but it still amplified the risk-off mood. At the same time, the market's favorite comfort story, hyperscale AI, lost some shine. AMD's air pocket, Meta's AI Capex hangover, Microsoft's soft tape, all fed into one question. Is the AI spend curve really as linear and painless as we've been trading it? Especially if policy leans tighter. That's the tension running through today's tape. Not a break, a reset in how much conviction investors are willing to assign to expensive, long-dated AI narratives. In the background, desk chatter shaped how people took risk. First, the Kevin Warsh story. Traders argued over whether a Warsh Fed would push faster balance sheet runoff or lean harder into anti-inflation messaging. None of that is policy yet. But the perception alone pushed macro funds to talk about pressure on high-duration growth and support for the dollar. Second, AMD. Unconfirmed talk about delays in its MI series AI accelerators hit just as investors were already nervous about insider selling and a huge run into earnings. That turned AMD into a lightning rod for the idea that the AI semi-trade is crowded and fragile. And third, Meta. Its multi-year, triple-digit billion AI and infrastructure spend plan kept making the rounds, with more investors asking how much margin and free cash flow give up that really implies. None of this chatter is settled fact. But together, it chipped away at the notion that AI spending is pure upside, with no cost and no timing risk. Gold dropped sharply today, not because of panic, but because pressure finally snapped. There was no single breaking headline, no macro shock. This move came from inside the market. Positioning was crowded. Silver weakened first. Liquidity thinned. Once leverage met falling bids, price moved faster than conviction. This wasn't a collapse in fundamentals. It was a reminder. When too many trades lean the same way, markets don't need news to move. Structure does it for them. Nvidia's $100 billion AI investment plan is paused. Not canceled, but reconsidered. For Nvidia, that's discipline. It's about pacing capital, not walking away from AI. But the impact isn't symmetric. OpenAI depends heavily on large, long-term infrastructure funding. When that capital pauses, markets reprice counterparty risk. This isn't a judgment on OpenAI's technology. It's a question about funding concentration and negotiating leverage. Nvidia stays the supplier. OpenAI becomes the variable. AMD was the clearest tell that the AI trade isn't bulletproof. The stock dropped more than 6% on heavy volume after unconfirmed chatter about delays in its MI series AI accelerators hit the tape, just as investors were already nervous about insider selling and a big run into earnings. Some analysts pushed back, but the price action spoke louder. As a core non-Nvidia AI proxy, AMD's slide showed how sensitive these names are to even vague negative headlines when positioning is crowded and policy feels less friendly. The message was simple. In AI semis, the bar for disappointment is now very low, and the penalty for doubt is very high. Meta was the other side of the AI discipline story. After a strong post-earnings pop, the stock gave back roughly 2 to 3% as the scale of its AI and infrastructure spend sank in. We're talking triple-digit billion Capex over time. Desk chatter wasn't about whether Meta believes in AI. It obviously does. It was about what that spend does to free cash flow, margins, and shareholder returns if revenue and monetization don't ramp in step. Meta's red tile, inside an otherwise mixed communication services space, highlighted a new phase of the AI trade. Investors are starting to price not just the upside of AI demand, but the cost and the duration of the build-out. Microsoft, the index heavyweight in AI bellwether, couldn't find its footing. After a prior day post-earnings drop on worries that Azure growth and AI monetization might not fully justify the pace of AI Capex and its premium multiple, the stock stayed soft as the Warsh headlines hit. No fresh blow-up, just no buyers at the old enthusiasm levels. For the Nasdaq and the big tech complex, that mattered. When the biggest AI platform name can't bounce decisively, it's a clear signal investors are less willing to pay peak prices for AI promises, while rate risk is moving the wrong way. Tesla cut against the grain. The stock bounced about 3%. Bright green while a lot of discretionary and high beta tech traded heavy. The driver wasn't macro relief. It was renewed interest in the robo-taxi and full self-driving optionality, helped by positive autonomy and SpaceX sentiment. So, traders are still willing to pay for very specific AI and automation stories, even as they de-risk the broader AI basket. Tesla's move didn't contradict the rotation. It refined it. Risk wasn't abandoned. It was selectively redeployed into names where the story still feels differentiated. Chevron became the poster child for where money is hiding right now. The stock rallied more than 3%, a bright green outlier on the S&P Heatmap as energy outperformed. Supportive commodity and earnings headlines helped, but the bigger story was preference. Investors leaned into hard asset, cash-returning businesses that look resilient if rates stay higher for longer. Alongside Exxon and the other integrated majors, Chevron's strength underscored the shift away from AI-heavy, duration-sensitive growth and toward value and balance sheet strength, especially on a day when precious metals cracked and the market was rethinking the Fed path. Eli Lilly quietly did a lot of work for this tape. The stock printed bright green as investors kept piling into its obesity and diabetes franchises and its broader defensive growth profile. In a market suddenly more skeptical of long-dated AI cash flows, Lilly offered something cleaner: strong demand visibility, pricing power, and less direct sensitivity to Fed chatter. That's why healthcare leadership broadened around it. For a lot of portfolio managers, Lilly has become a de facto defensive growth bellwether, a place to park capital rotating out of high multiple tech without giving up on growth. Looking ahead to the next session, the backdrop is simple, but not easy. A dense macro calendar is coming. ISM manufacturing and services, JOLTS, ADP, weekly claims, and the full jobs report with wages and sentiment. Any hot print can harden the Warsh's hawkish narrative. Any cooling can take some pressure off the long-duration trade. Against that, the AI complex faces a new kind of scrutiny. It's no longer enough to say demand is huge. Investors want pacing, payback, and discipline from AMD, Microsoft, Meta, and the broader AI ecosystem. If bond yields stabilize and these worries calm down, the recent de-risking can morph into a controlled consolidation. If rates or Capex anxiety flare again, today's rotation out of pure AI beta and into cash flow certainty may just be the first leg. We close with a market that still believes in AI, but no longer blindly. Indexes bent, they didn't break, volatility stayed in check. Under the surface, though, leadership changed hands, away from crowded AI and software toward energy, healthcare, staples, and select industrials. The key shift was psychological. Traders stopped treating hyperscale AI spending as an automatic win and started pricing pacing, structure, and risk. That's what made today matter. From here, every macro print and every AI-linked headline will test whether this new discipline sticks or whether the market rushes back into the old full-throttle AI trade. We'll be watching how that balance evolves at the next open. Thank you for watching Cat Eye U.S. stock. Stay curious, stay calm, and we'll see you next time.